Provide you with an introduction to financial options. So, a couple things about options. Options are contracts which give the holder the right but not the obligation to buy an asset at a predetermined price within a specified period of time. So there are a few things that we need to highlight here. So we have a call option, which gives you the right to buy something within a range of time. If you own a put option, you have the right to sell something within a predetermined amount of time. We also have to identify what the thing is that you have the right to buy or sell. Typically, these are stocks, bonds, foreign exchange, commodities such as oil. Bonds can also include things related to interest rates. Those are the biggest items that there are options that are traded for. The strike price or exercise price is the price at which you are able to buy or sell the underlying asset at. Or for. The expiration date, of course, is the last possible time that you have to be able to purchase or sell the underlying asset. The premium is the initial entry fee, if you will, that you have to pay for obtaining this right. So, for example, at the end of this presentation, I might be thirsty. And so I'm forecasting that I'm going to perhaps be interested in a bottle of water at the end. So let's say that you're a seller of water, and so I want to own a call option on one bottle of water with an expiration of 1 hour from now. Let's say you and I agree, should be expiration, that the strike price would be $1. So that's an example of a call option. I now own the right to buy a bottle of water from you an hour from now or before for $1. Of course, because I have the flexibility to buy the water from you or not, I have to pay you up front for that. So you might charge me a premium of, call it 10 cents. So the chronology of this would be, I give you 10 cents now. I now have the right to buy the bottle of water from you in an hour for $1 if I feel like it. And that's it. A put option would be the same type of contract, except it would be the right to sell. So let's say you have a contract with somebody else to sell your water to them tomorrow for $1.50. Well, now you own the right to sell it to them tomorrow for $1.50, and that's a put option, and they might charge you 15 cents to come up with that transaction. Let's take a look at a more realistic example. So here is a line item for a call option for Starbucks stock. Let's say today is fall 2011, okay? So there are call options that are traded on Starbucks stock, and the expiration on this particular call option is January 2012. 41 corresponds to the strike price. And of course, we can see it's a call option. So there's a call option that's traded on Starbucks stock that allows you the flexibility to buy a share of Starbucks stock on or before January 2012 for $41. So let's think about what this is. Let's say Starbucks is currently trading for $38 in fall 2011. Why would you want the right to buy something at $41 when it's only selling for $38 today? Well, you don't know where it's going to be 3 or 4 months beyond that. And so you want to speculate that Starbucks will rise above $41 on or before January of 2012. So why do these things exist? Like I said, you might want to speculate on future price movements of stock, or you may want to hedge the risk. So take this call option again. Let's say you're Starbucks and you're issuing equity, and you're issuing equity in fall of 2011. So you're issuing your equity at $38 a pop. What happens if you waited until January? If you waited until January, you could have gotten $41. And so in order to hedge the timing risk of the equity issuance, you may layer on options contracts onto your equity issuance to compensate you for something that adverse that may happen to the stock price that would cause you to not be able to obtain as much financing as you were hoping for. So uses of options are speculating, hedging, providing employees with compensation depending upon what something is worth later on, and as payment in merger and acquisition activity. Options are not used to raise capital. They're a side bet, if you will, on underlying asset prices such as stocks, bonds, commodities, and foreign exchange. Let's go back to the Starbucks example. Here's a set of quotes, and there are a lot of options here. Each one of these cells represents a call option that you can buy. So, for example, it would cost you $1.14. That's the premium, the price that you would pay up front to buy a call option on Starbucks stock with a strike price of 42 on or before October. So the date on this chart is September 16th, 2011. So you can see that an expiration of October 2011 only gives you about a month. So Starbucks is currently selling for $39.20. And so, again, each one of these prices represents a premium that you would pay for different contracts according to the strike price or the various expirations that you might choose. In this circled area, this represents the premiums for various put contracts, the right to sell a share of Starbucks stock on or before the specific expirations. which again appear below. So let's think about this for a second. Let's go back to the January call option with the strike price of 41. So let's identify what that is. Okay, so we're talking about a call option. Got it. Talking about January. Got it. Strike price of 41. So we find what that would cost. That would cost $3.40. So let's go down to here. The premium price that you would pay up front for this option is $3.40. Okay. So no matter what, if you choose to buy this, you're going to be out $3.40. So if nothing happens, you're going to be out $3.40. Let's say that's about here. Then depending upon where Starbucks price ends up in January, that will determine whether or not you made money or lost money. So let's think about this for a second. Again, you have the right to buy Starbucks stock for $41. So what happens if, and it's currently September, so you go to sleep for 4 months, and you wake up, and it's January, and Starbucks stock, you look at the quote sheet, and you can buy a share of Starbucks for $25 on the open market. So there's no way that you're going to exercise your right to buy it for 41. So instead, you're going to allow that option to expire without doing anything with it. And so the punchline is, if Starbucks stock ends up at $25, it expires worthless. And what did you end up losing? $3.40. So anything at or below the strike price of $41, and you're going to lose $3.40. The option's going to expire worthless. But what if you wake up in January and Starbucks is selling for $60? Remember, you have the right to buy it from whoever sold it to you for $41. So how much money will you make on that transaction? Well, you wake up and you exercise your right to buy it for $41, so that's going to set you back $41. And then you're going to turn around and sell it at the market price of $60, and you're going to pocket $19. Of course, you have to reflect the fact that you paid $3.40 for the right to do this. So you're going to end up with a total profit of $15.60. So that would be up here somewhere. So anything at or above the strike price of $41, and that would cause your losses or profits, losses to go down or profits to increase. Let's do another one. Let's say you wake up and Starbucks is selling for $45. Well, you own the right to buy it for $41, and you do that, and then you turn around and you sell it, which allows you to pocket $45. That's what it's selling for in the market. So you earned a payoff of $4, but again, it costs you $3.40 to buy the option. So you end up with a profit total of only about 60 cents. And that's what this was drawn to scale. That's what this would reflect. Okay. So this is the profit diagram for this call option. So you can see that this might be attractive. Why might this type of instrument be attractive? It limits your losses to the premium of the call or the put. In this case, the worst that can happen to you is you lose $3.40. Tends to have a big upside. So if you were thinking that Starbucks stock is going to go up to $55 or $60, you can make a lot more money by investing in options contracts than in the underlying equity. Remember, you're only investing $3.40 at the beginning, and you can earn $15. So you can earn 5 times your investment if the stock rises, versus if the stock was selling, if you bought it at 40 or 41 and sold it for 60, that's a 50% rise, as opposed to, again, a 500 or a 600% rise. So people who are interested in speculating on big price swings tend to use options. In addition, think of these a little bit like insurance diagrams or payouts. So think about fire insurance for your house. You pay a little bit of money this year, $1,000, call it, and if your house burns down, there's a big payoff. That's insurance. So how would it work in this type of example? Well, let's say you buy call options on oil because you're an airline. And so JetBlue or Southwest Airlines will buy a bunch of call options on oil prices. Because if oil prices rise, they know their jet fuel prices will rise, and they can't necessarily pass those cost increases onto consumers through higher airfares. So that's a big risk. So what they do is they buy call options on oil, and you can see that if oil prices rise, the options will pay off big, and that will cause them not to lose money if oil prices rise. It mitigates the risk of an oil price rise. And what do they have to pay? They have to pay up front for the right to buy that going forward. So here we have another example of a put option. So notice what a call looks like. A call looks like a hockey stick that's horizontal from the origin, and then it angles upward. How about a put option? So let's take a look at the Starbucks October 40 put option. So if you bought this, how much would it cost you? Let's go back to this. The October put option with a strike price of $40 will set you back $1.56. So the premium is $1.56. And as a reminder, the price for Starbucks is about $39.20. We've got a strike price of 40 and a premium of $1.56. All right, so far so good. So now what happens? So you pay $1.56 up front. And you have the right to sell a share of Starbucks for $40. So let's say you go to sleep in September and you wake up the third week of October when the put option is going to expire, and you own the right to sell it for $40, and let's say it's selling in the open market for $30. So that means that you can buy or sell as much Starbucks as you want for the market price of $30. So what do? You buy a share of Starbucks in the open market for $30. You exercise your right to sell a share of Starbucks stock. That's your put option, and you have an exercise price of $40. So you turn around and you exercise your right to sell it to the counterparty, whoever sold the thing to you to begin with, and you pocket the $10. Of course, you have to reflect the premium that you paid for this right. So you end up pocketing a grand total of $8.44. Pretty good for a $1.56 investment. So again, what happened? You wake up, it's selling for $30, and you have a profit of about $8.44. So notice, the lower the price goes of Starbucks stock, the more money you'll make because you have a fixed price of $40 that you can sell it for. So let's say in the extreme case, Starbucks goes bankrupt in the 3 weeks that you're sleeping. And what happens there? It's worth zero. You exercise your right to sell a share of stock that's worth zero. You pocket the $40 minus the premium of $1.56, $38.44. So it's going to be way up here somewhere, off the charts. So what happens if nothing happens to Starbucks stock and it ends up close to $40? Well, if it ends up worth $40, the worst that's going to happen is that you're going to be out your $1.56 premium. And so in this particular case, you can see that we end up with a payoff diagram. It's not really to scale up here. That's okay. It looks like this. That at high prices, why would you ever exercise your right to this should read sell a share of Starbucks stock. Okay. Sorry, that's okay. Exercise your right to sell a share of Starbucks stock. Okay. Put options. So let's say you wake up and Starbucks is selling for $60 a share. You would never exercise your right to sell it for $40 a share when it's selling in the open market for $60. So anything above the strike price and the put option expires worthless. So let's take a look at the diagram for a put option. It's a hockey stick again, except it angles up to the left. That is, put options make money when prices decline. So it's sort of the opposite of call options. Call options become more valuable when prices rise. So now you can see why we might want to use those to either speculate in the event of a potential price fall or hedge price risk. So think about ExxonMobil now. ExxonMobil makes more money when oil prices rise. And they're exposed on the downside if oil prices fall. So ExxonMobil can buy a bunch of puts on oil prices. So in the event of an oil price decline, their revenues will fall, but the put options will pay off, circumventing a loss. We can think of, again, what are these things used for? They're used for hedging foreign exchange, interest rates, commodities, equities, and a few other things, but those are the biggest. So the price of the yen versus the dollar declined by about 6% 2 days ago. So the value of the yen fell. Well, if you're EMC, you tend to sell about $100 million worth of storage units in yen in a particular year. So think about what happens if you price those contracts in yen, your customers pay you in yen, you go to repatriate that yen back into dollars, and if the yen has fallen relative to the dollar, that means that you're going to end up with 6% fewer dollars than you would have otherwise. And so 6% fewer dollars, that will cut your net margin in half in Japan. And so in order to balance out the FX risk, You can purchase put options that gives you the right to exchange yen for dollars at a predetermined exchange rate to hedge against a falling yen. So there's an example of an FX contract. So that gives us sort of an introduction to options. You should know a couple of other things. Let's talk about some of the drivers of these things. So what drives the premium of $1.56? What drives the call option premium of $3.40? Well, it tends to be things like the strike price and time to expiration. So if we go back to the chart, and if we go back to the chart and let's pick a different color. So let's just look across the call options that have strike prices of $39. What do you notice when the expiration is farther out into the future? The call options get more expensive. How about the put options? Same thing. So what do we observe? We observe that the longer the maturity, the higher the premium. And the reason is that the longer the maturity, the greater the chance that the call option or the put option is going to finish in the money. How about, let's hold the expiration constant. Let's look at these calls that expire in April 2012. Look what happens as we go down this column. The higher the strike price, the lower the cost of each of the call options. On the puts, on the other hand, the higher the strike price, the greater the value of the put option. Let's write this down first. So for calls, when strike prices go up, the cost of the call options go down. So think about what a strike price is. The strike price is the right to buy something. Well, would you rather have the right to buy something at $30 or the right to buy something at $40? Which one would you pay more for? Well, the $30. So I would rather own the right to buy something for a lower price. So I'm willing to pay more for that. So this one will be expensive. This one will be cheap, relatively speaking. And that's what we see here. The right to buy something will be cheap for a higher strike price. How about for the put option? For the puts, it's the opposite. So notice, remember, the put option is the right to sell something. Well, would you rather sell something at $40 or $30? I'd rather be able to sell something for $40. So that's going to be more expensive relative to the $30 strike price put. So for these, the higher the strike price, the higher the premium. So what this relates to really is the chance of the stock or whatever it is in the underlying asset to finish in the money. So if we go to the call option again, remember Starbucks is traded right now at the time of this exercise for $39.20. So it's right here. So the question is, what's the chance that Starbucks stock is going to decline in value versus the chance that it's going to increase in value? So we can see that there's a wide variation on the potential future stock prices of Starbucks, and anything above here, and the option will finish in the money. anything below here, and it's going to finish out of the money. And so the riskiness of a stock matters. So let me draw that out on, we already covered number 3. Let me draw this out here. Let's say, let's look at this one. Okay. So here's 2 potential stocks. And let's say that Starbucks is the green one. And let's say that Southern Company, which is a utility firm, is the red. So Southern Company looks like the safer stock, fine. But notice what also that means, that there's a lower probability of ending up in the tails for Southern Company. There's almost a 0 probability that Southern Company is going to end up way out here. And there's a positive probability that Starbucks is going to end up out here. So let me ask you a question. Let's say they were both trading at around 41 bucks. And you wanted to buy call options on each of them for $50. What's going to be more expensive? The call option on Starbucks or the call option on Southern Company? Notice, there's only a small chance that Southern Company stock is going to end up greater than $50. There's a much greater probability that Starbucks is going to end up greater than $50. So Starbucks call options are going to be more expensive. So let's just think about what we just said. Starbucks is riskier, so their call options will be pricier. And that goes on the left-hand side as well. There's a very small chance that Southern Company is going to end up at or less than $30 a share. There's a much larger probability that Starbucks is going to end up at lower than $30 per share. So the riskiness gets baked into the prices because it changes the chances of something happening. So we already showed the hockey stick for a call option. Again, this is called a long call if you're buying it. So, and we also showed this one, the hockey stick for a put option. So you might ask, well, when I'm buying a call option, who's on the other side of this transaction? Somebody's selling that to me. So whenever I'm making money up here, somebody else is losing money. Derivatives are zero-sum games. Whenever I'm close to 0, the counterparty is also going to be close to 0. Same thing for put options. Whenever I'm making money, somebody else is losing money. And whenever I've lost a little bit, they're going to make a little bit. And so these are the hockey sticks that relate to long and short positions in call options and long and short positions on put options. We could get a little bit more complicated and talk about strategies that involve multiple options. So what happens, for example, if you long a call, which looks like this, and you short a put option, and you put those together? Well, you'll end up with something that looks like this, the dashed line. So how about another one? So another one might consist of a long call option and a long put option. And you put it together and you get something that looks like a V. This is called a bottom straddle position. So notice the dotted lines. Here's our long put, and here's our long call. And we end up with something that looks like a V. Well, why would you want to do something like this? Well, let's say the stock price is selling for somewhere here in the middle, and you think over the next few months something is going to happen, but you're not sure what. And either it will result in something very positive for the company, or very negative for the company. You can bet on this volatility, if you will, by employing a long straddle position. So say, for example, you're looking at Martha Stewart in 2004. So Martha Stewart, you know, the jury's deliberating. Stock price is at $15. So stock price is around $15. So we're considering buying, for example, call options if we think the stock is going to go up. So let's say the jury returns a verdict of innocent, then you think the stock is going to go up, and you would speculate on that by buying a call option. But some people think that she's going to be found guilty, and that's going to hurt the company. And so they're buying put options for $2.25 apiece. And they're thinking that the stock price is going to plummet. So let's say if she's found innocent, the stock's going to go up to 20. And if she's found guilty, the stock's going to go down to 10. And again, it's currently at $15. But you're not sure how she's going to be found. So what can you do? Well, why don't we buy one of each? One call option for $1.30 and one put option for $2.25. So what would the cost be? The cost up front would be $3.55. So I know that if it ends up somewhere in the middle, or stock price ends up at 15, I'm going to lose my $3.55. If she's found innocent, then I think the stock price is going to rise to $20. If the stock price rises to $20, remember the call option I have has a strike price of 15. So the call is going to be worth, see, I own the right to sell it for $20. I'm sorry, I own the right to buy it for $15. Call. Right to buy. For $15. So if the stock ends up at $20, I exercise my right to buy it for $15. I sell it in the open market for $20. I pocket $5. But remember that I paid $3.55 for the call and the put. So I end up positive $1.45. So I end up at a positive $1.45 if the price ends up at $20. What if the price ends up at 10? At a price of 10, the put's going to be worth something. Remember, a put goes up in value when a price declines. What's the put going to be worth? Remember, I own a put with a strike price of 15. That's the right to sell. Well, if the price ends up at $10, I buy it in the open market for 10. I sell it for 15, and I pocket the $5 net of what it cost me to buy the put and the call. So I end up with the $1.45 that way as well. So notice that either way, I end up with $1.45. Now this might not seem like a lot of money, but remember a couple things. You spent $3.55 on this investment, and you're going to end up recouping that $3.55 and earning $1.45 no matter what. So you're talking about not quite a 50% rate of return for about a week's worth of work, and it's guaranteed no matter what if you believe that the stock price will either fall or rise by that magnitude when a verdict is announced. So clearly the risk is related to the movement in the stock price when a verdict is announced. And if it's really risky, you're going to do better off. And if there's not much stock price movement, then you might not make any money at all. So that's a straddle. And a straddle is essentially a bet A strategy is essentially a bet on uncertainty.